President Trump is lashing out at Federal Reserve Chair Jay Powell once again ahead of the Fed symposium in Jackson Hole later this week. In a series of tweets, the president said that while the U.S. economy is strong, Powell and the Fed are suffering from a horrendous lack of vision, in the president's words. Trump also said the Fed funds rate should be quickly dropped by at least 100 basis points. Join us now for more. Former Minneapolis Fed President Narayana Kocherlakota. He's currently an economics professor at the University of Rochester. It's great to see you, President Kocherlakota. Do you agree with the president in both the substance of what he's saying? Do you also agree with the tone and the very public way that he criticizes the Fed, or maybe you can agree partially with one and partially with the other? And I mean, where are you on that? He's very outspoken. Is he right about what he's saying, though?
So thanks for having me on. I agree with the president on the economics. I think, maybe not the 100 basis points specifically that he mentioned yesterday, but in general, I think the Fed has been too tight. You can see that in the inflation numbers. Inflation remains low. Inflation expectations remain low, below the Fed's target of 2%. So I think you can see that monetary policy has been too tight, and so that calls for more easing than we've seen in the past. And I expect more easing to be coming down the pike in the rest of 2019. I think the president's role, though, as the president of the United States, is not to be as out there criticizing the Fed. I think that can lead to doubts about the Fed's credibility going forward. It's not so much of a problem right now because inflation remains low, but I think that this opens up the possibility that presidents in the future, including President Trump, might be critical of the Fed about being too tight when actually there are inflationary pressures. And that's what we mean by lack of credibility, is that the Fed will lose its ability to fight inflation because people think monetary policy is being run out of the White House at the behest of short-term electoral pressures.
You think the Fed has been too tight for 10 years, and that's just so out of the consensus thinking, because most people think that the beggar thy neighbor global policies of central bankers of easy money, they think that it's really the opposite of what you're saying, that we've been way too easy for 10 years, and that's part of the problem.
I just judge by outcomes. We had high unemployment for far too long. Unemployment now, thankfully, is quite low. We've had low inflation. Inflation below the Fed's target of 2% for a very long time. There was maybe a slight blip upwards in 2011 that took us above 2, but by and large, over the last 10 years, we've been below 2%. And you look at the Fed's own, the way they make policy, the kinds of forecasts they offer for inflation, for example. They've been willing to tolerate low inflation for over very long periods of time, even in their outlooks. And so, yeah, I think I would stick to my claim. Monetary policy has been too tight for a very long period of time.
Professor, can you just explain sort of when you're in the room how the conversation around something like tariffs would manifest itself and how that would, and to the extent that effectively the Fed has to predict or at least make some kind of bets on what may or may not happen, how that works?
Yeah, obviously I'm not in the room now, and so I don't know how the conversation is proceeding about tariffs in particular. But, for when I was there, we were very uncertain about fiscal policy, about when certain kinds of tax cuts would take place or whether or not Congress would cut spending. And the way you view it as we in economics like to use this word exogenous. What does that mean? It means things that are outside your control. And so tariffs, the tariff policy that the president is pursuing is yet one among many things that are outside the Fed's control that are going to have important consequences for the economy. Different people around the table, I'm sure, have different outlooks about how the tariff policy will unfold, and that's going to affect their outlook, and that will affect as well about their feelings about monetary policy. If they think those tariffs are going to have a big downward impact on the U.S. economy, you're going to be in favor of more easing.
Right. Okay. There are two things that critics of being too easy that that they would bring up, Professor. One is that there's malinvestment, that there should be a cost of money. There should be, if you allow people to have money for free or even pay them to take it, that they're going to go and invest it in things where they lose their money. They're not going to get a return, and then we'll have the same kind of problem we had during the financial crisis in the housing market. The other one is that when we do have a serious break in global economic activity, we got no dry powder. We've got 6 total cuts unless we go negative, and those both sound reasonable. And how do you get around not worrying about either one of those two things?
So on the investment front, if we are really, so there are 2 ways people talk about malinvestment that I'm aware of. One is that we're investing in the wrong things, and the price of money, the price of credit at which you can get money, shouldn't affect whether or not you think one project is better than another. If a project's paying a higher return than another project, you should take that easy money and invest in the higher return project. That's the good thing. Now, the other thing people would say is, oh, we have too much investment going on. And I guess when I look at the investment numbers, it's hard for me to understand what the...
Well, it could be in emerging markets. It could be empty buildings in China. I mean, there could be a lot of places where you could see it, where we don't even know if it ever comes home to roost. But if no one's living in any of the buildings...
Chinese... I think it's... I'm not going to blame the Fed or central banks around the world
for emerging markets
for China's policies. So I'm sorry. What was the other?
The other one was we have no ammo.
Powder.
Next time, it used to be we could have 30 quarter-point cuts. What do we got now? We got what do we have in the tank?
So the way the Fed and myself think about stimulus when the recession comes along is it really matters in terms of what the interest rate you're trying to hit at that time looks like. And I think the problem that we're facing right now is that interest rates on the whole are typically going to be low, as we've seen. And so the interest rate we have to maintain to get to 2% inflation is low, or hit full employment is low. And so that means that when a recessionary shock comes along, we really want to have, as you're saying, a much lower interest rate. But that's not, if we raised interest rates now, we'd be just choking off the economy now. We'd have higher unemployment, even lower inflation, and things would be even worse if a recession came along. So that it's not about the rate of change in interest rates. It's always about the level of interest rates that matters.
Do you have any worries at all about just the global debasing of fiat currencies at all? Does that worry you at all as we rush to the bottom, or is it just what the current? I mean, we've got 17 trillion in negative rates. It just seems like something's amiss, and maybe I just hope it's not the pushing on a string that we're in the last throes of being able to keep this thing aloft before we hit stall speed.
So I am really, Joe, I'm very worried. And what I'm worried about, though, is I think something different from what you're worried about, which is I think the concern that you see in bond markets about the future is really tied to the lack of policy capacity that we have in central banks, that we're going to see these downside shocks, and central banks and the fiscal authorities are not going to be able to respond effectively. And that's going to lead to another recession of perhaps the magnitude we saw in hopefully not, but could lead to a recession of the kind of magnitude we saw in 2007 to 2009, with those same kind of persistent effects on output. And that's because it's the fear itself that breeds of low capacity that breeds the conditions where actually central banks can't respond effectively. So that's what worries me, and that's why I think we have these low nominal rates around the world. Is you look at German debt, for example, out to 10 years and negative nominal yields. This is all a fear factor, and we need to have better expectations of growth. I'm not sure where that's going to come from, though.
Okay. Professor, thank you. Appreciate all your time this morning and your perspective. It's kind of starkly opposed to Robert Shiller. Just had him on. He says we've actually hit our numbers on inflation for the most part and thinks we should be tightening. So that's what makes a market, I guess. But we appreciate your time.